This is the schedule where we left off in the last video. As you recall, our purpose here is to contrast results under the four different inventory costing methods. So in our example, we had these four umbrella sellers, and they all bought umbrellas and sold umbrellas for exactly the same amounts. And we're looking at the income statements for each of these four individuals, and you can see on top of their names what method they used for inventory costing. As I said in the last video, an obvious difference here is that you can see, coming straight from our earlier schedules where we computed the cost of ending inventory and the cost of goods sold, you can see the cost of ending inventory for Noah, who used specific identification, was $500. Cost of goods sold for Noah was $19.50, and these two things, as we discussed, have to add up to the total cost of goods available for sale. So for all of these umbrella sellers, cost of goods available for sale is the exact same amount, and sales revenue is the exact same amount. But because of the different assumptions being made about which costs get assigned to which items of inventory, the cost of goods sold and the amount of cost assigned to ending inventory vary across all of these methods. So, as you recall, sales revenue minus cost of goods sold gives us gross margin. So you can see when we get to this line item of the income statement that these four individuals all have different amounts of gross margin, and that's because cost of goods sold was different for each of them. After gross margin, we have $120 of operating expenses. And again, this is a highly simplified example. What we're assuming here is that each one of these individuals had to pay $120 for some sort of business license. So that was a cash cost for each one of these individuals, and also an operating expense. So when you take gross margin minus the selling and admin expenses, we have net income before taxes. And of course, these numbers are all different across the four individuals because gross margin was different across the four individuals. We're also going to assume that there's a 30% income tax rate that applies to these people. So 30% of net income before tax is the tax expense, and after you subtract tax expense, you get the net income. Now let's see if we can generalize anything from these results. Just looking at bottom line net income here, we can see that Larry, the FIFO umbrella seller, is reporting the highest amount of net income. So remember, all of these people started out with umbrellas that cost $300. They all purchased umbrellas for $2,150. They sold those umbrellas for $3,300, and they all paid the $120 for the license. Even though they all had those same transactions and those same effects on cash, the FIFO company had the highest net income of all four of these individuals. And the only difference between these individuals is their choice of accounting method. Why would FIFO end up giving the seller the highest net income? Well, FIFO is always going to have the highest net income if costs have generally been increasing over time. So in an inflationary scenario, FIFO should always result in the business reporting the highest possible net income, among these four methods. And that's because in FIFO, we assume that cost of goods sold comes from, we're using the costs assigned to our oldest inventory, and in inflationary times those oldest items should also have the lowest costs. So with FIFO, you would expect, again, this is in inflationary times, you would expect to have the lowest possible cost of goods sold. That means you're going to have the highest possible gross margin and net income before tax. As a result, you're also going to have the highest tax expense. Net income here ends up being $903. Now, as you scan across these numbers, you may say, well, it's just not that big of a difference. Well, this was, again, a tiny little example, but add 3 zeros or 6 zeros to these numbers, and you can start to see a fairly significant difference here between these numbers. Also, in our very highly simplified example, we've assumed that all of these umbrella sellers start out with inventory costed at $300 under their method. Over time, the differences between the cost of ending inventory and the cumulative amounts recorded as cost of goods sold can get larger and larger over time. So here we're just seeing one single month's difference in the net income being reported. Again, to generalize, if we are operating in a generally inflationary situation, or maybe it's not general inflation in the economy, but the goods that we're buying, the costs have generally been increasing over time, then FIFO is going to result in reporting the highest possible net income to your lenders or to your shareholders. Well, now let's look at the other extreme among these numbers here. So we could spot that FIFO gave us the highest net income, and LIFO is giving us the lowest net income, and we can use the same kind of logic here. Under LIFO, we assign costs to our items sold with the assumption that we sold the newest possible items. And the newest possible items in inflationary times would be the items with the highest costs. So under LIFO, we'll end up with the highest possible cost of goods sold being reported. That means we'll have the lowest possible gross margin, the lowest possible income before tax, the lowest possible tax expense, and therefore the lowest possible net income. Specific identification and weighted average will fall somewhere between the two extremes of FIFO and LIFO. If we think about effects on the balance sheet, you can see the same kind of thing happening. FIFO should result in the highest possible number being assigned to ending inventory because that's the cost of the newest items, and LIFO should result in the lowest possible number being assigned to that same ending inventory because these are the oldest possible costs. And again, specific ID and weighted average fall somewhere in between. Well, now let's think about cash. Which one of our sellers would end July with the most cash in their pocket? Here's a schedule that just reflects cash flows. So again, just for simplicity, I'm starting out here with an assumption that all four of these individuals have $1,000 of cash at July 1st. They each purchased the same umbrellas for the same amount, so they paid $2,150 to buy their inventory. We'll assume all their sales were for cash, so they collected $3,300 from their customers. They paid that $120 business license fee. So before you consider taxes, and this is a key point, before you consider the effect of taxes, all of these four businesses are in the identical position. The choice of inventory method affects the numbers that show up on the financial statements, but it doesn't affect cash flows, at least until you consider taxes. And when you consider the payment of income taxes, that's when choice of inventory costing method has an impact on cash. So these come from our previous computations of taxes, and after you subtract taxes, the use of cash to pay taxes, you can see that even though Larry, the FIFO seller, had the highest net income, Larry has the least amount of cash. at the end of the accounting period. Why? Because they had the same cash before considering taxes, and Larry paid the highest taxes. LIFO, Curly, who uses LIFO, Curly reported the lowest amount of net income on the financial statements, but because Curly paid less taxes, Curly has the highest cash flow in this accounting period. So FIFO is going to result in the highest possible net incomes but the lowest possible cash flow. LIFO is going to result in the lowest possible net income but the highest cash flow. And on this slide you see a summary of what I just said. Because of income taxes and because of those assumptions that we're using, LIFO results in the lowest taxable income and net income, and as a result, the least amount of taxes being paid, which means the highest cash flow. FIFO is the opposite. Now again, these things are only true when we assume inflation, either in the economy as a whole or just for the specific type of inventory being sold. In deflationary times or in an industry where inventory costs tend to be declining, perhaps because of gains in efficiency, something like that, then these rules would just reverse. In deflationary times, LIFO would result in the highest net income and taxable income and the lowest cash flow. And the same would be true with FIFO. These results would just reverse. So these rules that I'm giving you here only apply when we have inflation in our costs of inventory. The next thing that I want to mention here is very unique. It's called the LIFO conformity rule. So as you may have seen already, and certainly you'll see this as we continue through the course, companies need to follow GAAP, generally accepted accounting principles, to report on their financial statements, and they need to follow the Internal Revenue Code to report their taxable income to the IRS. And those are two very different rule books, and a company oftentimes is allowed to use one method for financial reporting purposes and a very different method that may be allowable for tax purposes. That's very, very common, and you'll see that's the case when we talk about depreciation expense a little bit later on. Most companies use a nice, easy, straight line method for their financial statements, and they use an accelerated method of deducting depreciation for their tax return because they get the benefit of paying lower taxes earlier on. Well, the LIFO conformity rule is sort of an exception to that general option that if you have different rules available, you can pick and choose whatever you like. The LIFO conformity rule is a rule that only applies if a company is using LIFO for tax purposes. And the rule is summarized right here. If a company chooses to use LIFO for reporting cost of goods sold and ending inventory for taxation purposes, then the company must also use LIFO for financial reporting purposes. So in this one instance, your tax method choice is also tying your hands for financial reporting purposes. It's called the LIFO conformity rule. So why do companies use LIFO for financial reporting purposes? Generally, it's because they want to use LIFO for tax purposes because they're in an inflationary context. Using LIFO allows them to report the highest possible cost of goods sold, and that results in lower net income and lower taxes. But once a company makes the choice to use LIFO for income taxes, generally accepted accounting principles say they must also use LIFO for financial reporting purposes. Now notice this is a very specific circumstance. If a company is using anything other than LIFO for income taxes, then this rule doesn't apply. So a company could use FIFO for tax purposes and LIFO for financial reporting purposes. They can use weighted average for tax purposes and specific ID for financial reporting purposes. In general, our general rule is still the same. Companies can use whatever methods are allowed. They can choose from the menu under GAAP, and they can choose from the menu in the Internal Revenue Code, with this one exception, the LIFO conformity rule. If they want to get that earlier tax deduction by using LIFO for tax purposes, then they're also going to have to show their shareholders that same lower net income. Now, if you think about it, remember that the difference between LIFO and FIFO or the other methods is just temporary. Over time, everybody, regardless of which inventory costing method they use, once they sell all of their inventory, all of those companies will have cumulatively reported the exact same cost of goods sold. So it's just the timing differences. But with inventory, that timing difference can persist for a very, very long time. And I think that's why it was Congress that came up with this rule. That's why Congress enacted the LIFO conformity rule. So in this very special case, what a company chooses for tax purposes can determine their choice for financial reporting purposes. The LIFO conformity rule explains why LIFO is the second most common method in the United States for financial statement purposes. It's because many companies wanted the benefit of those higher tax deductions in the early years, so they elected to use LIFO for tax, and as a result, they had to use LIFO for financial reporting purposes. Well, now that we've talked about some of the motivations for choosing a method, let's consider which methods result in what we would consider to be a higher quality of financial statement information. As there is often in life, there's a trade-off in the quality of financial statement information between the income statement and the balance sheet. LIFO is going to result in what most people would consider to be a more accurate cost of goods sold on the income statement. And the argument for this is that if you say a business is not just here today and this month, but it's going to be here in the future, that they have to replace their inventory. So under LIFO, cost of goods sold is fairly close to what replacement cost for that inventory would be. So that's an argument in favor of LIFO giving us more accurate results on the income statement. On the other hand, most of us would argue that FIFO is a much more accurate representation of the cost of inventory on the balance sheet. And in fact, the use of LIFO for an extended period of time, especially when there's been high inflation, can result in really low, inaccurate inventory valuations on a balance sheet. I don't know if I talked about the motivation actually for using FIFO in financial statements. Not everybody chooses to use LIFO on their financial statements, or LIFO for tax, which means they have to use LIFO on their financial statements. The most common method for inventory costing in the U.S. is FIFO, and there's a couple of reasons for that. One is that I think companies like to show that higher net income to their investors, and so that's a plus for FIFO. And the other reason is that, again, FIFO probably more accurately, at least generally, matches the way companies actually do sell their inventory as far as the physical movement of goods. And so FIFO still is the most common method here in the U.S. One of the things that you'll see in the footnotes to the financial statements is that companies with inventory will provide detail in their notes as to what inventory method or methods that they're currently using. A cost that a company has, an additional cost that a company has for the decision to use LIFO for inventory purposes, is that under GAAP, if a company uses LIFO for reporting their cost of goods sold and ending inventory, they have to provide information in the footnotes that would allow a reader to convert those numbers to another inventory method such as FIFO. And that's required so that if you're comparing two companies and one uses FIFO and the other uses LIFO, you can convert the LIFO number to FIFO and you'll have an easier time of comparing results in those financial statements. All right, well, let's do one final note. Let's add one final note as far as inventory costing methods go. I want to speak just for a minute or two here again about the difference between the perpetual inventory costing system results and a periodic inventory costing system results. Recall that under the periodic method, we assume all sales occur at the end of the accounting period. We don't try to compute cost of goods sold as we go. If you're using the periodic method, you would just do one, and you're using, let's say, a LIFO computation, you would just compute the cost of goods sold or the cost of ending inventory under LIFO at the end of the accounting period. Only one computation is necessary. If you're using the perpetual method, every time you sell something, you have to build that inventory reconciliation schedule like I showed you, and you compute cost of goods sold just for that item that you're selling right then. And then the next time you sell something, you do another inventory reconciliation schedule and you compute the cost of that item under LIFO or whatever method you happen to use. So you're going through, it's the same idea, but you're going through it many times. What we did in the NOAA example as a major simplification is we set our problem up so that it never rained for the whole month of July, and then it started to rain and NOAA and the other sellers finally started to sell their umbrellas. So in our example, all of the umbrellas were physically sold at the end of the accounting period. Because of that simple assumption, you would get the same result whether the company was using a periodic method or a perpetual method for recording cost of goods sold. The examples that you'll see in this class, as far as anything on a quiz or an exam, will have that same simplification. Either all the sales will occur at the end of the accounting period, or I will tell you that for this purpose a company is using the periodic method, and then you just assume that all of the sales occurred at the end of the period. All right, well, we have one more very important topic here for inventory, and that is our principle or our theory for how we report the cost of inventory on the balance sheet. As you've seen, a company tracks its cost of inventory using one of those inventory costing methods you learned about. So they track their inventory carefully, they update it throughout the year or at the end of the year if they're using the periodic method, and at the end of the year they'll have this unadjusted balance in the inventory account that reflects the results under FIFO, LIFO, or one of those other methods. What GAAP says is that there needs to be one more check on that number. What GAAP says is that all companies should report their inventory on the balance sheet at the lower of cost, or this thing called net realizable value. So cost is cost as determined under our inventory costing method. Again, it could have been FIFO, LIFO, or something else. And net realizable value is defined right here. Net realizable value is the estimated normal selling price of that item less any predictable costs of completion, disposal, and transportation. So what a company wants to report on their balance sheet is inventory at cost, or if net realizable value is lower, they're going to report their inventory under net realizable value. And that's going to, when net realizable value is lower, the company will need to do an adjusting entry. Now there's actually some more complex rules that apply when a company is using LIFO inventories. We're not going to talk about those here. The general rule for other inventory costing methods is just this lower of cost or net realizable value rule. So this is something that every company that has inventory needs to consider at the end of the year. So when they're doing their various adjusting entries for depreciation, bad debt expense, or whatever, if they have inventory, they need to go through all of their various inventory items and come up with what's the net realizable value of those items, and they need to compare it to cost. If net realizable value is lower than cost, then they do an adjusting entry, they reduce their inventory, and they record a loss. The result of the lower of cost or net realizable value rule is that the companies will end up recording losses in the period where the value of their inventory declined below cost, instead of waiting to record that loss when they actually sell the item. Let's do an easy numerical example because I think that will help a lot. So we'll assume that you have a business and your business sells widgets. So at the end of the year, you have 30 widgets sitting on the shelf, so 30 widgets in your ending inventory, and using whatever your costing method is, you've determined that the cost of those 30 widgets is $7 each. So in your inventory account at the end of the year, before any adjusting entry, you have a cost of $210. You need to, at the end of the year, determine what the net realizable value of those widgets is. Okay, so let's assume that at the end of the year, you estimate that the selling price for the widgets is $7.50. You know that you have a sales commission that you pay of 20% of the selling price. So the $7.50 minus the $1.50 sales commission gives you a net realizable value of $6 per widget. $6 times 30 widgets is $180. So the net realizable value, basically the amount of cash you expect to realize when you sell those widgets, is $180. So what the rule tells us here is that we compare cost to net realizable value, and our inventory needs to be valued at the lower of those two things. Since 180 is lower than 210, this inventory needs to be on the books at $180. Remember, 210 is what was in the account. This would be the adjusting entry that would get recorded. We reduce inventory so that it's reflected on the balance sheet following this rule at the lower of cost or net realizable value, and the other side of the entry would either be a loss, or sometimes companies just increase the cost of goods sold account. The main thing that I want you to know is there would be a $30 reduction to net income here. Well, let's consider a different example here. So we have the same 30 widgets, the same cost determined under, let's say, FIFO of $7 per widget. So in the account, we still have that $210. Now this would perhaps be the more normal situation, right? At the end of the year, you need to once again compute the net realizable value of those 30 widgets. You estimate the selling price of the widgets is $10. If you subtract the 20% or $2 sales commission, the net realizable value of the widgets is $8 each. What kind of adjusting entry would be necessary in this case? Well, if you take that $8 times 30 widgets, that's $240. We want our inventory to be on the books at the lower of the cost of $210 or the net realizable value of $240. In this case, net realizable value is higher than cost, so we want our inventory to be on the books at cost, or $210. Because our inventory is already on the books at $210, no adjusting entry would be necessary. Note that we will only ever write our inventory down. We never write our inventory up. Adjustments For writing inventory down, in the instance where net realizable value is lower than cost, those kinds of adjustments are more common in some industries than others, so they can be needed when your inventory quickly goes out of style. If you're in a high-tech kind of business where merchandise gets out of date quickly, or where costs just keep getting cheaper and cheaper over time, again because of gains in efficiency or something like that, then those would be the most common situations where you would expect for there to be a write down of inventory. Really important thing to remember here is that this is our valuation rule for inventory, and that as a result of this rule, companies have to do one last check of the balance in their inventory account at each balance sheet date. They may need to write their inventory down if net realizable value is less than cost, but they'll never be writing their inventory up.